Welcome to Skilled MBA Case Study Series in Accounting. Faraz Usmani's strategic capital budgeting for Herbo Drugs involves estimating the cost of capital crucial for expansion. This financial analysis focuses on determining the optimal investment of R6.5 million to modernize and expand the traditional Unani remedies market across India, ensuring sustainable growth and competitive advantage. Herbo Drugs and Pharmaceuticals, based in Prayagraj, aims for national expansion. Under the leadership of Faraz Usmani, the firm plans to introduce traditional Unani remedies to modern markets. This ambitious growth strategy necessitates a capital investment of R6.5 million, highlighting the need for precise financial planning. Scaling operations across multiple Indian states demands a thorough capital budgeting analysis. The challenge lies in determining the accurate cost of capital for a private firm like Herbo Drugs and Pharmaceuticals. This financial crossroads requires strategic decision-making to ensure successful expansion and sustainable growth. Net present value, NPV, measures value creation by discounting future cash flows. A positive net present value indicates value addition. Internal rate of return, IRR, identifies the percentage return on investment which must exceed the cost of capital. Profitability index, PI, is the ratio of present value to initial investment, aiding in ranking investment opportunities. Cost of capital is crucial in financial analysis, acting as the discount rate. It signifies the minimum return investors expect. Misestimating it can lead to poor decisions, jeopardizing expansion plans. Accurate calculation is essential to ensure sound investment choices and sustainable growth. Weighted average cost of capital, WACC, is crucial for evaluating investment opportunities. It combines the cost of equity and debt, reflecting the average rate a company is expected to pay to finance its assets. Accurate WACC calculation ensures sound financial decisions, balancing risk and return effectively. Private firms face unique challenges in valuation due to the absence of publicly traded stock prices. Without market data, estimating beta becomes complex, requiring innovative methods to assess systematic risk. Determining the cost of equity involves creative approaches, often relying on comparable public companies or industry averages to approximate the firm's financial metrics. The comparable company approach involves identifying a listed pharmaceutical firm with a similar business model to Herbo. First, unlever the beta of the comparable to remove financial leverage effects. Then, relever this beta using Herbo's 80-20 capital structure to accurately reflect Herbo's risk profile. The cost of equity is calculated using the Capital Asset Pricing Model, CAPM. Here, the risk-free rate is derived from Indian government bonds, the relevered beta is specific to Herbo, and the expected market return is based on Sensex. This calculation reflects the return expectations of Herbo's family owners. Growth assumptions are crucial for forecasting Herbo's financial future. We anticipate a 15% annual sales increase during the initial 5 years, followed by a 10% growth rate in the subsequent 5 years. This sets the stage for calculating the terminal value, assuming a perpetual 5% growth rate, essential for long-term financial planning. The cash flow model begins with the R6.5 million initial investment. Years 1 to 5 project a 15% annual sales increase, marking a rapid growth phase. Years 6 to 10 anticipate a stabilization phase with 10% annual growth. A perpetual 5% growth rate is used to calculate the terminal value, ensuring long-term sustainability. Net present value should be positive when discounted at the weighted average cost of capital, indicating value creation in rupees. The internal rate of return must surpass weighted average cost of capital significantly, offering a percentage return measure. A profitability index over 1.0 signifies value creation, with higher values reflecting greater investment efficiency. Private firms should select comparable public companies for accurate beta estimation. With 80% equity financing, precise cost of equity estimation is vital. Growth projections must align with market data and industry trends to ensure realistic financial analysis. Pharmaceutical growth in India is region and product specific. Traditional medicine shows a 12 to 18% annual growth potential, necessitating tailored investment strategies for urban markets. Herbo's expansion taps into the rising demand for natural remedies in metro cities, aligning with industry trends and consumer preferences. Thank you, and Faraz's expansion plan requires rigorous financial analysis to ensure sustainability. Private firms must adopt flexible capital budgeting strategies to balance growth with financial stability. Traditional businesses can expand while preserving their heritage, ensuring a legacy of success.